In this lesson, we will examine ethical principles and practice standards. By the end of this lesson, you should be able to discuss in detail the CFP Board's Code of Ethics, describe the CFP Board's Rules of Conduct and the Board's definition of fiduciary, and explain disciplinary rules and procedures for violation of ethical principles, rules, and regulations. Jonathan R. Macy, professor at law, offered the following insight in his paper entitled Regulation of Financial Planners. Just as individual financial planners have incentive to establish a reputation for honesty and competence in order to attract clients, so too does the profession as a whole. As a result, the financial planning profession has incentive to police itself. The general public deserves to be protected, and they deserve the highest levels of integrity and ethical standards. There are several levels of policing which ensures compliance. It starts at the industry level with self-regulation. An example of this is the CFP Board, Board of Standards, Code of Ethics, and Professional Responsibility. The financial planning firm is expected to self-regulate. There should be a firm's Code of Ethics and a firm's compliance program, and in many situations will be held to fiduciary standards. The CFP Board's Standards of Professional Conduct offers guidelines which are summarized in 5 sections. Section 1, the Code of Ethics and Professional Responsibilities. Section 2, the Rules of Conduct. Section 3, Fiduciary Planning Practice Standards. Section 4, Disciplinary Rules and Procedures. Section 5, Fitness Standards for Candidates and Professionals eligible for reinstatement. The CFP Board's Code of Ethics and Professional Responsibility, which applies to both the CFP Board designee, i.e. those practitioners certified to use the CFP mark, and all candidates for CFP certification. It offers broad aspirational principles that are expected when dealing with the public. The 7 broad principles are integrity, objectivity, competence, fairness, confidentiality, professionalism, and diligence. These principles are enforced because they're integrated into the rules of conduct. Let's take a look at each of these principles in more detail. Providing professional services with personal integrity means working with clients in a way that embraces honesty and candor. Avoiding any element of deceit, for example, misleading statements or misrepresenting in advertising. Remembering always that our personal integrity is the foundation for client trust and the cultivation of a long-term relationship, and never sacrificing honesty for personal gain. Winston Churchill once said, "If you have integrity, nothing else matters. If you don't have integrity, nothing else matters." Integrity is a concept that flows through all definitions of ethical activity. Perhaps that is why integrity is listed as the first principle in the Code of Ethics. The second principle is objectivity. To provide services with objectivity means acting with impartiality, maintaining intellectual morality, and applying prudent professional judgment in finding out what product or strategy is best for our client's needs and situation. The third principle is competence. The financial planner needs to acquire and maintain the skills, knowledge, and qualifications necessary to fulfill the scope of the planning engagement. Continuing educational, personal study, and inquiry are necessary to keep pace in this dynamic industry. Another aspect of competence is self-assessment. It's important to recognize the limitations of our knowledge, We can then either restrict our work to areas in which we're competent or take steps to expand our knowledge base. Consider the following example. Jackie, a CFP professional, realizes that she doesn't have the knowledge background to assist the client with income tax preparation. Therefore, she refers her client to 3 competent, ethical income tax practitioners. So that way, her client can decide who would be the best match. Principle 4 requires that all CFP designees and candidates perform professional services in a manner that's fair and reasonable to clients, principals, partners, and employers, and shall disclose conflicts of interest in providing such services. Full transparency and commitment to fairness will go a long way in promoting trust. We're required to disclose all material information relating to the professional engagement and inform the client about conflicts of interest, those situations or professional relationships that could influence or bias the recommendation. The 5th principle is that of confidentiality. A CFP certified planner is expected to hold client data in complete confidence, unless the client consents to allowing the release of the information. Only authorized persons can have access to client information. If you're collaborating with other professionals in the development of the plan, then you'll need to obtain permission from the client before sharing client-specific information. Confidentiality extends beyond the client to the employer. We have a responsibility to ensure employer confidentiality. Professionalism. To act in a manner that demonstrates exemplary professional conduct. That means demonstrating courtesy, respect, and dignity to our clients, the general public, our colleagues, and employers. We need to always conduct our activities and act in a way that will reflect credit upon the financial planning profession. For example, Sandra, a CFP professional, meets Tom during a community luncheon. Upon discovering Sandra's profession, Tom proceeds to tell her how inept and uncaring his current financial planner acts. Rather than talking about this other planner in a derogatory manner, Sandra explains how she works with clients and offers to set up an initial meeting. The 7th principle in the Code of Ethics is diligence. To provide professional services diligently. Elements of this principle include delivering services in a timely manner, conducting reasonable investigation of products or strategy alternatives, and entering into the engagement only when you have the ability to provide effective services. The CFP Board's Rule of Conduct establishes norms which protect the public and advance our profession. The rules of conduct contain 4 sections. 1. Clearly define the relationship with the prospective client and clients. Accurate disclosure of material information to prospective clients and clients, including no misleading information. Disclose conflicts of interest. Transparency about compensation. 3. Protection of client information and property. For example, client confidentiality, the storage of files, the commingling of funds, and the borrowing of monies. And obligations to client, employer, and the CFP Board, including treating clients fairly, providing services with integrity and objectivity, compliance with laws and regulations. As previously mentioned, the rules of conduct encompass the broad ethical principles. It is within these standards of conduct that the ethical principles are enforced. Failure to follow through with ethical behavior in working with clients is subject to disciplinary review. An important issue in the rules of conduct relates to when the practitioner engages in a financial planning engagement. Specifically, if the certificate's services include financial planning or material elements of the financial planning process, then 1.2, agreements need to be in writing, and 1.4, certificate owes to the client the duty of care of a fiduciary. So, what constitutes financial planning or material elements of financial planning which automatically require a written agreement and a fiduciary level of care? There are 4 issues to consider when assessing whether or not the engagement is financial planning. 1, the client's understanding or intent. 2, the degree to which multiple CFP subject areas are involved in the scope of the engagement. 3, comprehensiveness and relevance of the data gathering. And 4, the scope and depth of recommendations. Note that it's not necessary that all 6 steps of the financial planning process occur, or that all the financial planning areas be addressed, or that a written plan be developed and presented in order for the engagement to be considered financial planning. Just the client's belief that you're providing financial planning is enough. Integrative planning across a couple topic areas is probably enough. Engaging in one area of the plan now with expectations of continuing work at a later point is enough. On the other hand, just filling out an IRA application or a mutual fund form for the client or preparing a federal income tax return would not constitute financial planning. When in doubt, it's probably best to assume that you are in a planning engagement. The fiduciary level of care is now an integral expectation of CFP practitioners. The updated terminology for Rule 1.4 of the Code of Ethics, effective July 1st, 2008, states, "A certificant shall at all times place the interest of the client above his or her own." When the certificant provides financial planning or material elements of financial planning process, the certificant owes to the client the duty of care of fiduciary, as defined by the CFP Board. The CFP Board's definition of fiduciary is one who acts in utmost good faith, in a manner he or she reasonably believes to be in the best interest of the client. As discussed earlier in this lesson, fiduciary responsibilities include duty of loyalty to the client, duty of high standard of care, duty of diligence in making recommendations, and duty to disclose all conflicts of interest. Summarizing this slide, it's important to remember that the baseline standard of care for any work is that a CFP practitioner must always place the client's interest first. If the engagement is deemed to be a financial planning engagement or contain material elements of financial planning, then the certificate is required to offer the fiduciary standard. There will be grounds for disciplinary action if the certificate is found to be guilty of violation of the CFP Board's principles, violation of criminal law, any act or omission that violates the Board's disciplinary rules and procedures, or false or misleading statements to the CFP Board. The disciplinary rules ensure that the principles and practice standards are maintained and that our clients are being protected and provided with the highest quality service. The CFP Board disciplinary rules offer an excellent example of industry self-regulation. There are 6 levels of disciplinary action depending upon the Board's findings. The disciplinary actions include no action, continuing education, unpublished private reprimand or censure, a public letter of admonition, suspension of the right to use the CFP mark up to 5 years, or permanent revocation of the right to use the CFP mark. Refer to the CFP Board's Disciplinary Rules and Procedures document for detailed information. Your firm will also establish and maintain ethical standards and operating policies, and you'll be obligated to comply. These standards will generally include the firm's ethics code, the compliance program, for example, in such areas as promotional materials, maintenance of client records, documentation, and corporate operating procedures. Note that many of the standards are required by federal and state law or regulation, and failure to comply can result in criminal and/or civil penalties. In this lesson, you learned about the CFP Board's Code of Ethics, the CFP Board's Rules of Conduct, the CFP Board's Definition of Fiduciary, disciplinary rules and procedures for violation of ethical principles, rules, and regulations.